Well, hello and welcome to this broadcast featuring Kogo Capital and the trust deed lending opportunity that exists through Kogo Capital of Orange County. My name is William Jordan, and I'll be walking you through the opportunities available tonight. And you should also see on the side of your screen a place where you can ask questions. So as we go along, if there's something you need clarification on, feel free to type a question in there, and I will do my best to get to those questions as we go. You might find, if I don't answer it immediately, that maybe I recognize we're going to answer it a little later, or maybe I'm just not seeing it on the side of the screen. But with that, let's go ahead and jump in. We've got a lot of content we're going to cover, and we'll do it in a condensed amount of time here on this webinar. So first, the standardized disclaimer. And, oops, there it goes. So first, the standard disclaimer. I'll leave this up for a moment. This is just the general page that says, you know, we are not your parents, we're not your mother, we're not telling you what to do. We consider everybody who's on this webinar to be an adult and to be able to make their own investment and financial decisions. So you can read this full disclaimer, and it's all of those legalese that everyone needs to say in this day and age. And if for any reason you're not able to read it fast enough, send us a notification. We'll send it to you in print, but I'm going to move on now. And so who am I? Who is William Jordan? As much as I don't like spending any time really talking about myself, just to give you maybe 30 seconds, you can read a little bit about my background and my bio. I am the CEO or president of Kogo Capital of Orange County. I am also separately president of one of the premier wealth management firms in the nation, which is known as William Jordan Associates. You can find a number of books I've written on Amazon, things of that nature. Do a lot of talking and speaking about financial planning, money, and investments at various places around the country, as well as some television, radio, and things of that nature. So enough about me. You're here more to learn about the opportunities available to you. And we're going to talk about those in the context of three significant challenges that today's investor is facing. The first is finding yields without taking unnecessary or excessive amounts of risk. And I literally had a conversation today with a gentleman who was sharing with me that, is there any place that I could get 3 or 4% on my money while still keeping it pretty safe? I think by the end of this conversation, you're going to feel like that's on the very, very low end, and people should be thinking much higher than that. Beyond just the yield, though, there's also the protection of principal, and the specific issue related to the protection of principal for fixed income is rising interest rates. We're going to touch on how that has the potential to really damage your wealth and your wealth accumulation abilities. And then thirdly, diversification. Stocks, bonds, or, quote, mutual funds, which are then groups of stocks and bonds, have really been the investments for the last 2, 3 decades, 4 decades potentially even. And is that really the only way to diversify our portfolio? What other options and alternatives are there? That's what we're going to be able to talk about here. And I've done this basic conversation before. I've been talking about trust deeds, and specifically what I call double secured first trust deeds, since back in 2010. Actually, I could even rewind further than that, and I first became aware of them as places savvy people were putting their money in the late 90s. But more recently, we did this conversation in May of 2011, and you can see here were the interest rates at that point in time. And you know, CD rates and treasuries and even bonds just doing lousy from an interest rate yield standpoint. Not a whole lot to get excited about. In fact, when I show people that 5 or 6% interest rate on bonds, many would question, where are you even getting that number? I can't even find that. But that's the Moody's report that's actually put out by the government. The data's there on how to look that up. And then the last item you'll see on that list is trust deeds, or double secured first trust deeds. And that 10.76% interest rate, as you see along the bottom, was the actual interest rate from a third-party private portfolio. So that was not necessarily your results. Everybody's results can vary, and there's the standard disclaimer. But that was an actual real performance that was being generated in a privately managed portfolio. Now I'm going to advance the screen, and it's going to look almost the same, but this is going to be updated to the time that this webinar is being recorded. So you see we go from May of 2011 to June of 2013. And what do you notice that's significant? Well, I'll highlight 2 things. The first is most of these interest rates have hardly changed at all. And they've actually come down some over the last few years, then they've moved up a little bit over the last few years. But notice as well, look at that trust deed number, 10.81%. What was it before? It was 10.76%. That same portfolio, and that is the same portfolio manager, that would be myself, and same portfolio of trust deeds being managed. Obviously, the trust deeds have come and gone within that portfolio, yet the yields have been amazingly consistent. And maybe not so amazingly. As we talk here, you're going to see why we're able to achieve excellent yields in fixed income opportunities, namely trust deeds. And I think you'll find that they're very appealing and really address a lot of the issues that we raised just on the other screen. The core problem facing investors to me right now, and we listed all three, and all three of them are issues. Yield is an issue, protection of principal we're going to talk about here is an issue, and diversification is an issue. Protection of principal is the problem that most people are not aware of or are only now becoming aware of. And I've been speaking on this for several years, and for most of the last 2 years, I sounded like a broken record who wasn't really making any sense because I was warning that as interest rates go up, bond values will fall. Now, that is a factual, true relationship, and any person savvy or even roughly familiar with interest rates and fixed income investments will agree when interest rates go up, bond prices fall. And yet I had countless arguments with folks who would say, no, I'm in individual bonds, so I'm safe, or I'm in short-term bonds, or I'm in high-yield bonds. Let's make this just a bottom-line statement. When interest rates go up, bond prices will fall. Now, interest rates for the last few years did nothing but trickle down even lower than where they had been when they were near all-time lows. We've just experienced the lowest interest rates in modern history. You could argue we've experienced some of the lowest interest rates in recorded history, but certainly in the last century or more. So given that interest rates have been at the all-time low, it would be an easy question to ask, where do you think interest rates are going in the future, up or down? Now, 98% of people ask that question will say they're going up. The other 2% will say, I have absolutely no idea. So they are going up. Now, when are they going up? No one can say. There is no one with a crystal ball who can predict this, and yet interest rates will go up over time. That will cause bond values to fall. And this is a chart. I'm not making a recommendation here. This is not a specific investment that's for anyone's suggestion. This is just as an illustration, as an educational component. But this is an ETF that represents the entire U.S. bond market. This is the performance only for a 6-month period of time from the beginning of 2013 until the end of June or July 1st, 2013. You can see the dates down at the bottom. I'm not sure if you can see my mouse, but if you can, I'm circling that. In the lower right-hand corner, you see the small red number that's negative 3.42. What that tells you is this ETF of bonds, the average bond basically in the United States has lost 3.42% of its value in the last 6 months, or in the first 6 months of 2013. At the same time, the yield for this ETF was 2.45%. Now keep in mind, that's the annual yield, which means the semi-annual yield is 1.225%. So you've made 1.2% and you've lost 3.4%. And remember, bonds are supposed to be the safe investment in your portfolio. They're what most financial advisors are going to use as a counterbalance to the stock market to provide protection. Well, let's be really frank here. Bonds will not provide the protection you need them to provide in the coming interest rate environment. The last time we were at interest rates remotely similar to where we're at today being the middle of 2013, the last time we were at similar interest rates was at the end of World War II. Interest rates from the late 40s through the late 70s did nothing except rise. Slowly at first, and then they eventually hit that bubble that we had in the late 70s with stagflation and such. And you remember when you could get CDs for 11, 12, 14% in some cases. I've actually seen people who have 30-year government bonds that they purchased in 1981 where the interest rate was 12.5%. So that was the ridiculous interest rate environment we were at. But here's what's important for you today as you're trying to make decisions about generating safe yields with your money. What's important is that while those interest rates were rising, from the late 40s to the end of the 70s, fixed income investments lost money relative to inflation for almost 4 decades. From that entire period of time, we actually had the 50s, the 60s, and the 70s where fixed income investments lost money in relation to inflation. So we're not even talking about just not making much in the way of yield. We're talking about losing money, and that's exactly what's happening right here. And this gives you a perfect example of why what I've just said is true. Because even if you have a little bit of yield, and over time, even if that yield goes up as interest rates go up, the principal risk that you're taking is significant. And this is true even with individual bonds, especially if they are long-term individual bonds. Locking in long-term bond rates right now could be one of the worst mistakes you ever make. I'm not going to belabor that point. I think we've hit it clearly enough here. Let's go ahead and move on. So we said there were 3 significant challenges: finding yield. We saw on the previous page, average bond in the United States paying around 2.5%. Protecting principal. We've just seen that bonds are losing money, even from a principal standpoint, not even in relationship to inflation, which makes it even worse. And then diversifying. If you go to your wealth manager and you say, I need to diversify my portfolio, they're going to say, no problem. Let me give you some different stocks and bonds to diversify your portfolio. Well, folks, that's not diversification. That's just more of the same. And what has worked in the past is not necessarily what will work in the future. You have to consider the environment that you're in. So that leads us to what I believe is the best opportunity in the financial world today. Been saying that since 2010. Been saying it for the last 3 years. It continues to be true, and it's true today. And I've even called this the golden age of trust deed investing in my book, The 7% Solution. So utilizing trust deeds may give you the opportunity to have a lower level of risk, probably potentially even much lower level of risk, with higher yields than other fixed income options. And I'm going to explain why that is, because the number one question that I get from folks is, okay, if something sounds too good to be true, it probably is, and this sounds too good to be true. I'm going to explain to you why this actually does not sound too good to be true, why this is just a very logical opportunity that exists based on the craziness we've seen of the banking environment and the real estate market over the last 5 years. That is what created this opportunity in 2010. That's why it's still present today, and why it'll still be available for some period of time to come, though how long is somewhat anybody's guess. Now here, and you can read the rest of the screen. I'm not going to waste your time by reading every point to you, but I will highlight that an individual trust deed, any place that you're going to put your money that's not government guaranteed, is going to be considered to have some level of risk. That risk can be reassigned. You basically can pay an outside fund to take on your risk from these trust deeds using what we refer to here as the buyout agreement. And that is a specific option that is available to our clients. This is not something that's available to everyone, and to my knowledge, we are the only firm that has this kind of a relationship where there's an outside entity, an outside fund, willing to take on the risk of the trustee defaulting, of the borrower not paying you back. They will pledge their money to buy the note back from you for exactly what you paid for it if the borrower defaults and you don't want to take the property through foreclosure. So you keep control, you keep choice, and for a little bit less interest, you've eliminated, you have assigned that entire risk. So trust deeds can also lower volatility, can increase expected returns, diversifying your portfolio, and the range we've thrown in here is 8 to 12. I often will say to folks that you should expect to be between 7 and 10% net of everything. Can we at times do better than that? Yes, we can. But if you're going to take the most conservative option, expect to be in that 7 to 10% range, and if you want to make sure you're maximizing your rate, we'll show you the different ways that you can do that. Private money lending may solve the challenges that we highlighted. The returns are outstanding, and what I really love about trust deeds, and what I think many of the clients we've worked with love, is that the terms are shorter. You do not need to lock your money up as you do with, say, a bond for 10 or 20 years. You're making, in many cases, a 12-month loan. We see loans as short as 6 months. We've seen them anywhere from 2 to 5 years, but the average note is almost 12 months in length. And this is a very tangible, real asset, and real in the legal terminology as in real property, not just in the psychological terminology. When you lend money by purchasing a bond, you're making a loan, and what you're hoping is that the borrower will pay you back. The borrower could be the federal government, could be a corporation, a municipality. That is what a bond is. It's simply a loan agreement between you and whoever's issued that bond. Now, I live in Orange County, California. Orange County is famous for, a number of years back, going bankrupt. One of the richest counties in the country filed for bankruptcy, and if you held an Orange County bond when they filed for bankruptcy, you were out of luck. In the bond environment, in a loan environment, what you're usually worried about is, will this borrower actually pay me back? Am I going to get my principal back? I think it was Will Rogers who said, it's not the return on my investment I'm worried about, it's the return of my investments. So that's the concern with bonds, but in a trust deed environment, you have a tangible asset backing up the loan. So for just sample numbers, if a property was worth $200,000 and you've lent $100,000 on that property, and the borrower who had to write a check for their own $100,000 and has that skin in the game, the borrower says, I can't pay you back. Who has the problem in that situation? Well, let's be blunt. It's not the person who lent the money. It's not you. It's the borrower, because you're going to take that property and you're going to go sell it, hopefully for $200,000. Maybe you only sell it for $150,000 because you take it back and you just want to unload it fast. Could be more or less. I'm just giving you a hypothetical scenario, but the point is there is a real asset backing up your loan. That is why we have a buyout agreement, because there are funds that buy these kind of notes that would love to buy the assets that back them. And by buying the note and then foreclosing on the property, they're buying the asset cheaper than they could on the open market. So that is truly, it's a win-win scenario. It's not a too good to be true type of scenario. And then one of everybody's favorites, it's hands-off investing. This is not something where you have to do all of the work. You can outsource most or even all of that work to our firm to be able to assist you with this. We're going to do the research. We're going to put all the package together, provide you with all the details, provide you with the appraisal on the property and all the information. If you want to know about the borrower, we're going to give you that information as well. You're going to be able to identify what is a fit for my risk tolerance, what's a fit for my comfort level. And you can do that by reviewing examples of loans that we have funded. And then you come back to us and tell us, William, this is what I'm looking for. I'd like to lend only 50% loan to value, and I'd like that property to be in Southern California, or I don't care what state it's in. And I would like to have a borrower whose plan is to sell the property in less than 6 months, and I want one that doesn't require any construction or repair work to make it habitable, and et cetera, et cetera. You can be as specific as you want, or you can be as general as you want. Our job at Cogo Capital of Orange County is to make sure that the borrower and the lender are getting a fair deal. Folks, obviously I make the emphasis about if a borrower doesn't pay you back, it's really their problem. But our goal is not to take advantage of a borrower. Our goal is actually to help provide a benefit to a borrower. We are lending them money when they couldn't otherwise access that money because the banking environment is so crazy right now that it's hard for them to get a loan. You can have great credit, great income, and just still not to be able to qualify for a loan as an investor. Or if there's one little problem with your credit report, or you can't fully document all of your income, or maybe you already have a couple of properties, and they say, well, we don't think you could really afford to buy another property. This investor, as a real estate investor, is losing out on those opportunities. I'll give you a specific example. I had a client of mine approximately a year ago make a loan here in California. The borrower went into default. They didn't pay the loan back when it came due. Now, they had the property on the market. They were selling the property, and I guess they figured they'd pay the loan off when it sold. So here's what happened. Now, the loan was about $300,000. The property was on the market for over $500,000, about $540 if memory serves. It was very close to that. And we started the foreclosure process because the borrower wasn't paying our lender back. Well, we got only 3 or 4 months into the foreclosure process, and the borrower sold the property and went to pay off the loan. Now, keep in mind, and if you're a borrower, don't go late on the loan. Call and ask to negotiate an extension. Usually you'll pay a fee for that, and then you can extend the loan. Okay, there's a solution there. But if a borrower does not give us the professional courtesy of communicating and of negotiating in good faith and holding up their end of the bargain, we are going to enforce our rights to protect our lender. So the borrower had to pay late fees. The borrower had to pay accelerated interest. Long story short, over almost a 12-month period of time of having made this loan and it paying off, my clients generated a rate of return that was 18% on their money. That's right, I kid you not, 18%, just less than a year's period of time. Now, here's the point that I'm trying to make. Because when I say that, when I saw that, I think there's a part of me that thinks, oh my gosh, we really took advantage of somebody, or we really gave them a hard time in it. The borrower called my client as the lender. They were on title as the lender. So the borrower calls my client, and guess what they said? Thank you. They called my client simply to say thank you. You loaned me this money. You allowed me to be able to buy this property. My family profited a tremendous amount of money from this, and I wanted to thank you for lending me this money. Folks, the point I'm making here is making a good or even a great interest rate on a private money loan like this is not a too good to be true scenario. You are providing to a real estate investor a valuable commodity, namely cash, that they might otherwise not be able to buy or take advantage of a real estate investment. And in this case, the investor made a six-figure profit on the property. My client made an 18% return. Everybody was happy. Everybody benefited, even though the borrower ended up paying extra costs and fees that they really could have, for the most part, avoided. So the difference here, keep in mind, we're talking about really both sides of the real estate opportunity or of the trust deed lending opportunity. The private lenders is who I'm primarily talking to here at this point in time. You're looking really to place your cash into something that's going to pay you a good rate of return. Your job is to find a note that's fundable. We're going to help you do that, or we're even going to do that for you. Obviously, you want to make sure that the borrower is going to be able to pay back the note. If you're a real estate investor and you're listening to this and you're thinking, I'd love to access some of that money, go find a deal. Go find a real estate opportunity where you're going to be able to generate income off of that. Doesn't have to generate income the day that you buy the property. It could be vacant. It could need some repairs. But go find a deal. Find a lender. We will help connect the two of you together in that regard. Make sure the income's larger than the loan payments, expenses. That point is, if you're the real estate investor, do your homework. Do the numbers and make sure that you can afford to borrow the money and that this is going to be a good deal for you. And folks, we turn away borrowers all the time, and we tell those borrowers, this is not going to be a good deal for you. We don't want to be known as the company that's trying to take advantage of anybody who makes a mistake and put some of their money on the line, and we basically just take advantage of it on behalf of the lenders. We want the lenders to benefit, and we want the borrowers to benefit, because if both sides benefit, then both sides will continue coming to the table and continue working together, and that relationship lasts a much longer time. Whereas if the lenders take advantage of the borrowers are going to go away, right? And if the borrowers are taking advantage of the lenders are going to go away. So you have to make sure that it's a fair, equitable, win-win scenario for all the parties that are involved. And on the real estate investor side, you can see it's a little bit more involved. There's a lot to do. You've got to become an expert. It's a business that you're pursuing, and so you really need to develop some expertise in that business as a real estate investor. On the right-hand side of the screen, the real estate banker or the private money lender, what do you have to do? You have to give us a call, let us know how much money you'd like to have invested. We'll talk through the different options with you, and you're good. And so you're going to make money all through the transaction. Now, who has the potential to make the most money? No question, it's the real estate investor. Remember, my client, they got a phone call. Hey, I paid you 18%. I'd be ready for that person to just scream at me through the phone, hey, thanks so much. Boy, paying you 18% was one of the best things that I ever did. That tells you something. That tells you the real estate investor made a heck of a lot more money than 18%. On the client side, they were thrilled with 18%. Yeah, they were more than thrilled with 18%. In fact, the problem that exists at that moment is my client says, hey, find me another one of these deals where the lender's going to go late. Boy, that was fantastic. Doesn't happen that often, and so for the most part, it's just pretty much going to play out the way we're telling you to expect it to play out. But that's still a great deal for everybody involved. If you can make 7 to 10% on your money with a high degree of safety without having to lock it up for a long period of time and giving you good diversification and avoiding interest rate risk if interest rates start to rise, well, that's it. I mean, I've called this the holy grail of fixed income investments, and it really is akin to that because it's accomplishing all of the goals. Now, this is an involved slide, but if you want to read it in detail, it basically just shows you there's a whole cycle here. What we do is we get involved at the very beginning with the real estate investor. When they find the deal that they're trying to put together, they come to us. We help them package up the loan. We review everything. We review the appraisals. It goes through our underwriting committee. Folks, we're going to look at this loan, and before we put it in front of one of our investors, we want to know that our money is going to go into this deal, that we would be willing to put our own money at risk in this because it's a great loan to make, and we turn down loans in that underwriting process. As long as they follow our guidelines, they fit in, and it's a good fit for our lenders, we're going to pass that on to our select lenders network. We have a network of people that are interested in and ready to and able to fund these deals, and your opportunity here on this webinar is to join that select lenders network. And there's no subscription. You don't have to pay a membership fee or anything of that nature. There's a few simple qualifications, and we'll touch them on them at the end. But basically, it's just that you have money to lend, and you're able to look at a transaction and make a decision in a relatively short period of time, because if not, we have a lot of other lenders in line that are waiting to do that and are able to do that and have the money ready to go. Because our borrowers need to close, and they need to close in a short period of time. So we work with the borrower, we work with the lender, we help make sure the transaction is going to benefit all parties, and that as long as the borrower doesn't do something crazy or stupid, they'll come out of this with a wonderful experience, making a great level of profit, and come back to become a repeat borrower so that we can give you, as our lenders, the loans that you desire and that you need. So an outline of what we do, and I've touched on most of this, so I don't think I need to walk through the whole process again. More just to emphasize that this is a real, straightforward, and traditional real estate transaction. We're going to use a title agency. We're going to use an escrow company. The money is all going to be held by third parties. There's no funny business here. Folks, we live in the post-Bernard Madoff world, so we might as well just ask the question and answer it head on. How do I know if I make this kind of loan, I'm never going to see my money again? And how do I know somebody's over there isn't just trying to pull the wool over my eyes? Real estate has the wonderful property, unintended, that you know where it is. You know where to find it, and you can confirm who owns it. And what's going to happen through the escrow company, that's an independent company whose sole job is to hold one person's money and another person's title to the property and make sure those are changed at the right time in an appropriate way. The escrow company is going to file that note as a recorded note with the county recorder's office. And you get a copy of that, and you can independently verify all of that. So you're dealing with something that is extremely verifiable. This isn't the Bernard Madoff world where he just started printing paper and put your name on it and said, here's how much money you had. This is the exact opposite of this. It's tangible. It's real. You can put your hands on it. You're going to get a check on a monthly basis, and if the borrower defaults, you can take advantage of the buyout agreement and get your money out within 30 days and then move on to do the next transaction. So I love trust deeds for that reason is, even though it's not the traditional stocks and bonds, that's why trust deed investors have been out there for so long. It's really more the realm of the savvy, wealthier folks, and our goal is to make this something that's available to everybody. Yeah, we've got clients that have millions or tens of millions of dollars, and we've got clients that have tens of thousands of dollars or hundreds of thousands of dollars, everywhere in between. And there are borrowers out there that need large loans and small loans. We've funded loans as small as $15,000. We've funded loans above $1 million, just one loan. So there is something to fit everybody there, and it's safe and it's secure. And the rest we do as promised. We coordinate the transfer of the money, handle the whole process, utilize the servicer to make sure they're processing the checks, getting your checks to you on a monthly basis, keep you advised of all the loan status. We're really just To the extent you want, we're doing everything here for you. How do you get involved? It's very simple. Our website's right there. I don't think you can click on the link, but you can type it in, kogocapital.com/Orange County. If you want loans in California, or if you live in California, make sure you type in the /Orange County. There'll be a little investor form to fill out there, pretty quick. Sign the agreement. You're not pledging anything. You're not committing to anything. You're just telling us, hey, this is kind of what I'm looking for. And then we will follow up with you to find a loan that's going to fit your comfort level. We'll arrange the closing. You sign the documents. The borrower signs the documents. It all goes to the closing office, and everything's transferred, and then you earn interest payments. And you might laugh when you catch my 5B or my subpoint under 5B, because keep in mind, I own a wealth management company. I also am the president of Kogo Capital of Orange County, and I'm the majority owner of Kogo Capital Orange County. So it's seriously as well as a little tongue-in-cheek when I say fire your financial planner. And why do I say that? I say that because, and forgive me, but my small axe to grind with the financial planning world, why isn't your financial planner bringing you something like this? It's a loan secured by a piece of real estate. Okay? It's not rocket science. Mortgages happen every single day. Thousands of mortgages happen every single day. They've been going on for decades, centuries, and arguably millennia. Why isn't your financial advisor bringing this to you? Because it's not a stock, it's not a bond, and it's a pain in the neck for them to do the extra work. I'm serious. When I first started utilizing trust deeds, and people would ask me, why isn't my financial planner telling me about this? I would say, first of all, most financial planners really don't understand real estate. My quick background very fast, I bought my first home when I was 21, before I got into the financial planning business. So I understood the value of real estate. I understood that real estate was a great investment. It's been my favorite investment my entire life. Now, that didn't stop me from telling my clients in 2005 to get out of real estate, and that's exactly what I told them, and that's what I did myself. But it's also the reason why in 2010 I said get back into real estate. And those dates look pretty good in retrospect, but financial planners weren't in real estate because they viewed it as competition. After all, if you're a financial planner and somebody invests their money in a piece of real estate, how much do you get paid on that? And not to imply that a financial planner would recommend or not recommend something based on what they get paid, but we know that that happens, and we know that that's in the back of their head. So why are financial planners down to some extent on trust deeds? It's not something they can do, or it's just not something that they want to spend the time on. Having been involved now with Kogo Capital of Orange County and running this firm, I can tell you it is a lot more work than you would think on our side, because we're doing all of the work for the clients. So there's a lot more work that goes involved into it. And why do most financial planners not want to do it? Because they're lazy. Yep. You heard it here if you didn't already know it. And I said that I emphasized this in my book, Strategic Wealth. You can go out and grab a copy of it. I do encourage you to do so. And I really poked some holes in our industry because the financial planning industry has some problems. And that's why I'm proud and excited to be the president of Kogo Capital of Orange County and have a firm that emphasizes trust deeds. And that's all that we do as a company is trust deeds. Kogo Capital is not a wealth management firm. It's not a registered investment advisor firm. We just handle trust deeds. But if we're giving you something that effectively allows you to replace your financial planner, do you think they feel a little bit threatened? Yes. And if they do you think they're going to say this sounds like a great idea? Or do you think they're going to try to come up with all kinds of baloney reasons why you shouldn't be doing this? That's exactly what they're going to do. It happened to me back in the late 90s. When I was early in my career in the financial planning world, I was finding investors that I was talking to about stocks and bonds, and those investors were investing their money in trust deeds. So I went to my manager and I said, hey, people are investing their money in these trust deeds and they don't want to invest in stocks and bonds with me, but they're getting 12% and it seems pretty safe. What do I tell them? And my manager gave me all of these quote-unquote reasons why someone should not invest in trust deeds. Now, I'm a reasonably smart guy. It did not take me too long to figure out that the reasons, so-called, that my manager was giving me were really just scare tactics to try to scare people out of trust deeds and into investing in stocks, bonds, and mutual funds with us. And so I rejected those. I wasn't able to offer trust deeds in the late 90s to my clients, but when I found the people investing in it, I said, hey, that's great. Keep doing that. And if you've got other money you want to invest, then I'll manage your other money. So I love the fact that I also own a financial planning firm, but sometimes I hate the fact that I have to be associated with financial planners that are outside of our firm in that industry, because sometimes we get too hung up in this is the way we've always done it, or this is what we're told to go out and promote, instead of just asking the question, if I could find a safe place for my clients to park their money and they can make 7 to 10% interest without having to commit it for a long time, why wouldn't I encourage them to do that? And so I invite anyone who has a financial planner that's telling them why they shouldn't do this. I will do a conference call with you and your financial planner, and they can ask me any question they want. We'll put a specific transaction in front of them and let them say and ask anything they want. At the end of the conversation, you get to decide, what do you want to do? Because after all, it's your money. The question and the answer to that question will really be very simple. So that's really bringing us to the end of our presentation. And at Cogo Capital of Orange County, our team is here to help take care of this process for you. We are here to do the work for you. I have some clients who are very involved. They want to see every deal. They want to see every document involved with. They don't mean they see every deal, but on any deal they're looking at, they want to see every document involved. They're going to rip it apart and put it back together. By the time they're ready to lend money on that, they almost own the property. They know it so well. They probably know it as well as the person who's buying the property in the first place, but that's their level of comfort. And then I've got other clients. I talked to one today, said, hey, I'm calling you because here's the trust deed. You told me that we've talked before. We've made investments before. This is the fit for you. And they said, boy, that trust deed, it sounds exactly like the ones I've done before. Why don't we go ahead and do this? And that was it. They don't need to look at all of that because we've developed a trusted relationship where they know we're going to look out for their best interests. And they've got that buyout agreement as well as that extra level of security. So they really are able to have a good comfort level about taking advantage of this. I am tired of hearing people talk about getting 1% on their money or being excited if they manage to get 3% on their money. Folks, if you're getting 2% on your money right now, on your, quote, safe money right now, and we can just upgrade that to 8%, you realize that's a 400% increase in the income that your money is able to generate for you. Now, if you are, excuse me, if you're in retirement, that's a 400% increase in the lifestyle income that you're able to take. If you're just investing to grow your money for the long term and you have something that can generate 8 to 10% without stock market risk, boy, I absolutely have seen people make decisions to reallocate their portfolio. And again, Cogo Capital does not give financial advice. We don't give investment advice. We don't recommend if you buy or sell one thing or another. That's a choice that you're going to make of your own accord. But we'll provide you with the educational information that you need to fully understand first trust deeds and to get excited about taking advantage of them. I hope this time has been helpful for you. I'm going to suggest, obviously, the website. Go on there, fill out a lender form, and we'll be able to follow up with you to answer some questions. If you'd like to read a little bit more about this, there's a short book that I wrote, which is called The 7% Solution, that really outlines what we've talked about in maybe a little bit more detail. Or you can read my full financial planning book, Strategic Wealth, and that gets into a lot bigger picture of both the trust deeds and different ways that they can be utilized inside a portfolio. So there's a lot of education out there for you. But let me close by just making the point, I think, very simple. We talked about the problems. It's hard to find anything paying you much in the way of yield. You have the risk of losing principal as interest rates start to go up, and you're not diversified your portfolio if you're just in stocks and bonds or mutual funds filled with stocks and bonds. Well, who's always making money? The bank is, right? The bank makes money, they make loans, and they make money on the money you put on deposit with them. So how about instead of those problems, you basically become the private bank, and we help you do it. You take your money, you lend it on a piece of real estate, just like smart bankers do. You get monthly payments from that borrower, just like the smart bankers do. And when the borrower is ready to sell their property, they have to pay you off. And so you get your principal back, just like the smart bankers do. If there's a problem, there's 2 layers of security there to protect you. And there's the Cogo Capital Orange County team that is here to help make sure that your finances can be far more of a success than they have been in the past. So we're going to go ahead and thank you very much for your time. I'm going to wish everyone great health, great prosperity, and thank you for spending your time getting to know Cogo Capital of Orange County just a little bit better.